Hi guys, welcome to episode 2 of our new series breaking down Econ-Jargon. And I'm thrilled to have with me one of my close friends from St. Andrews. We were together from the first day of our Econ lectures in first year, and I'm glad to have her on board. Sanaa, thank you for joining us and thank you for being with us today.
Thank you.
For everyone joining us for the first time, this is the Eye on Econ. Please subscribe to our YouTube channel and more importantly to our Instagram page because we will put up a set of slides linked to real world case studies. And the purpose of this is not only to educate potential econ students, but even if you have no interest in the subject, it's good to and that is of fiscal policy. And I thank Sanaa for curating a few very, very helpful slides for you, which I will share on screen now as Sanaa starts to explain what fiscal policy is.
Hi guys, so it's good to be here, and hopefully we can help you learn a little bit of econ. So the first one being fiscal policy. It's basically, in simple terms, it's the expenditure that the government does to either expand the economy or contract the economy. So, for example, let's just take a very basic example. If the government wants to buy furniture for the parliament, if they buy tons of furniture for the parliament, of course, they are helping out the local furniture owners or company owners who will further increase their production, which will further increase their employee ratio and the number of people they hire, which is basically, it's going to have like a domino effect, which will eventually improve the economy. And the same way, if there's inflation happening or there's oversupply in the economy, they can also contract it. And do you want to add on something before I move on a little bit?
Perfect, Sanaa. That was a brilliant explanation there. And I want to own in a bit on the two tools that you've highlighted, being government spending and taxation. So the government uses these tools to influence economic conditions or macroeconomic conditions, as we call it. And if we refer back to my first episode last week, where we discussed the components of aggregate demand, I spoke about consumption and government expenditure. And that is basically what these two tools of fiscal policy try to address. Through government spending, you're directly looking at the G component of aggregate demand. And the more government spending there is in an economy, the higher your aggregate demand. And with taxation, higher the taxation, lower your disposable income or the income that is left over for consumers once all tax payments have been made. So you're kind of trying to curtail consumption expenditure. And I'll break this down even a bit more for you in terms of expansionary and contractionary fiscal policy. Expansionary fiscal policy is when you stimulate government spending and you reduce taxation. So you're trying to promote aggregate demand, so increase consumption and increase government expenditure. Contractionary fiscal policy is when you do the opposite, when you increase taxation and reduce government spending. I want to give a quick example, a relevant example of fiscal policy being used in during the time of the pandemic. So in Sri Lanka, in a bid to combat all the economic hardship brought about by COVID-19, amongst many things such as tax deferral mechanisms, the government provided 2-month cash subsidies of Sri Lankan rupees 5,000 to affected households. And that is an example of trying to promote government spending to stimulate demand at a time in which your economy is stagnant due to the pandemic. So that was just a quick example of where fiscal policies come in handy. And Sanaa, I hand back to you to explain monetary policy and the right side of the diagram.
You've definitely covered it quite well. So just to conclude this definition of fiscal policy, you can say, so for example, during a recession, the government will employ expansionary fiscal policy by lowering the tax rates and increasing the aggregate demand to eventually fuel economic growth. And when there's inflation in the economy, the government will pursue contractionary fiscal policy, which is by increasing the tax rate and decreasing the disposable income of the people in the economy. So should we move on to the next definition then?
Perfect, Sanaa. And just a quick reminder to all our viewers right now, please feel free to comment and engage with us, and we'll entertain your questions as we go on.
Okay, so the next one is monetary policy. Monetary policy basically refers to the actions which are undertaken by the central bank of a country to control the money supply and achieve economic growth. So monetary policy can, again, be based on if they want to expand the economy or contract the economy again. And to go into a little bit further detail, we can say like tools which are included in the monetary policy would be direct lending to banks, bank reserve requirements, unconventional emergency lending programs, and any sort of help that the central bank can provide the commercial banks as well as the private banks to increase their credibility.
Very well summed up, Sanaa. That was immaculate, Sanaa. And just to add on to what Sanaa just said, right? Again, you look at expansionary and contractionary monetary policy as well. Whenever you hear the word expansionary, think of it as a government's attempt to promote or to stimulate the economic growth, like in a bid to like reduce, in a bid to like lower unemployment and avoid recessions. Whereas contractionary monetary policy would be adopted in order to reduce inflation. We will get to these terms like inflation in a future episode, but in a nutshell, what monetary policy does is it uses the interest rate and money supply to try to increase and tamper with liquidity in a bid to promote or restrict growth when needed. So when would you want to restrict to promote growth, right? But you use contractionary monetary policy where you restrict money supply and increase the interest rate in order to try to reduce inflation. So if you look at the Bank of England, for example, the Bank of England has set an inflation target of around 2%, if I'm not mistaken. And what that does is, if an economy is going beyond that threshold, the Bank of England will try and propose contractionary monetary policy by trying to increase the interest rate or reduce money supply in order to reduce inflation. And how does that work? At the point at which you increase the interest rate, the cost of borrowing increases. So people are less incentivized to borrow in order to spend. And at that point, going back to what we discussed earlier about consumption expenditure, at the point at which you're less incentivized to borrow, and if that leads to less spending, your consumption decreases, your aggregate demand decreases, and you kind of curtail and restrict demand pull inflation, is what it's called in economic terms. But don't worry about this jargon. This is the point of the series, to break this down for you as we go along. And what is also interesting to note is, if you look at what certain countries have done to tackle COVID or to try to tackle COVID, is a mixture of the two. They've played around with fiscal policy and monetary policy to try and promote some form of growth in their domestic environment. And I think that is an important point to note, because COVID-19 is a perfect example of both a supply and demand shock to an economy. And we'll get to supply shocks and demand shocks maybe next week if we have some time. But in a nutshell, what we just want you to ascertain from this diagram is that a government has two different branches to work with, either fiscal policy or monetary policy, and they could also use a combination of both. Sanaa, my question to you on this is, when we were first taught this in uni, what many people kind of liked studying about fiscal policy. I thought many people understood quite vaguely what government spending and taxation was about. But monetary policy was a completely different ballgame altogether. What is it about monetary policy that made it very difficult for certain econ students to relate to it at the onset?
I think there's a reason why the central bank and the government are two independent bodies as well, because it's very complex to function as, together as well as individually. And while government spending is a little easier, monetary policy becomes a lot more complex because there are a lot of elements within it. So what we're talking about currently is just basically, interest rates and taxes and just the upper layer of it, basically. But because there's so many fluctuations and the economy is constantly changing, we didn't know when we were hit by a pandemic, and now we made it through 2 years, and we still don't know where we are. So it's just the constant fluctuation, because of which it's very, very hard to keep track of what's going to happen to the central banks, how much are they going to be able to, loan or lend, and and they're in control of money altogether. And it's not just within the country's economy, because it's global. It's globalization in general. I think it's a lot harder to keep track of it.
Very well summed up there, Sanaa. And I think what is also interesting, and I think you addressed this in your reply, was the fact that I think the complexity around monetary policy revolves around the fact that there are so many instruments to play with, right? You're looking at bank reserve requirements, you're looking at interest rates, you're looking at government bonds that banks must hold, you're looking at things like quantitative easing. All these will be broken down for you in a future episode. Now that we've addressed that, I want to move on to two very simple terms, that we hope you kind of relate to and understand. I'll take on progressive taxation, and I'll leave the opposite of it being regressive taxation for Sanaa to sum up. So basically, in a nutshell, progressive taxation is where you have lower tax rates on low-income earners and higher tax rates on high-income earners. So you kind of segment the population into two, or into many different channels rather, and increase the level of taxation as you go up the income channel or you go up the income ladder. Many countries adopt this. They consider it to be fair to have progressive taxation because it isn't much of a burden on the low-income earners in society. But there are a few countries who like to cater to the wealthiest amongst the population and to try to prevent things like brain drain, for example. And they adopt the inverse of this, being regressive taxation. Sanaa, would you like to take this on?
Yeah, absolutely. So basically, where the term brain drain that Viren is talking about is when most of the high-skilled workers in the country decide to move out, because since they're earning more, they're expected to pay more in taxes. So to avoid those increases in taxes, they move out to a different country where they would potentially, let's say, a country that employs the regressive taxation system, because then they would have to pay like a standard tax rate or income tax rate, which is applicable to all the residents irrespective of their income level or the amount that they earn. So this basically shifts all the talent from a progressive tax country to a regressive tax country.
Yeah, brilliantly said. And I think the Robin Hood effect, as we know it, where you steal from the poor and give it to the rich, comes from this term of regressive taxation. I also want to before we move on, I kind of want to also highlight that both these terms of progressive taxation and regressive taxation all come under what we discussed earlier in terms of fiscal policy, in terms of the taxation stream of fiscal policy. So just a quick reminder that fiscal policy was about taxation and expenditure. So both progressive and regressive taxation come under.
I think I'll just expand a little more on the regressive tax because we didn't really cover the exact definition of it. So the regressive tax basically is the tax rate that diminishes as the taxable amount increases. And in simpler words, we can say that there's an inverse relationship between the tax rate and the taxable income. So but it's easier said than done though, because there's mostly, it's a standardized tax which is applied to all. It just affects the proportion of income that is earned. So let's say one of the examples of regressive tax is sales tax. And a sales tax would be applicable on a pair of Nike shoes. So if you're buying a pair of Nike shoes and the sales tax is 10%, that 10% of a person earning $1 million a year would be a lot less as compared to a person earning $10,000 a year. Well, that's a little less. They can't really afford Nike shoe, but maybe, person with a low proportion of income, for them, the shoes would cost a lot more. So it's just a standardized tax rate as compared to the progressive tax.
And just adding on, finally, so regressive taxation is called the inverse Robin Hood effect, as I said earlier.
Yeah.
Progressive taxation is the Robin Hood effect, where you kind of steal from the rich and cater to the poor, and at that point you get the inverse of it for regressive taxation. I want to now. We still have a few more minutes. We don't want to take too much of your time during each of our episodes, but I think we have ample time to discuss one last set of definitions that are all linked to this payoff matrix that you see before you, right? I've spoken about the prisoner's dilemma in an earlier episode, and I hope you remember the fact that the prisoner's dilemma revolves around both players being stagnant at an equilibrium that isn't their best, that doesn't give them their best payoffs, but they do so because the incentive to deviate would cost them very significantly. And if you want to know a bit more about the prisoner's dilemma, please, I would urge you to watch the session I had that was exclusively on the prisoner's dilemma. But I want to cover two key definitions linked to this payoff matrix that you see here. So as Sanaa has put it in a very succinct manner, right? This is between, you have your two players, Samsung and Apple. They both have two strategies independently, right? It is either to cooperate or to deflect / defect, right? And at that point, this is the two strategies that each of the players has. Sanaa, do you mind breaking down this payoff matrix for our viewers?
Yes, absolutely. So I think the prisoner's dilemma very well shows how individuals pursue their own self-interest. And in this example, basically, we've taken Apple and Samsung. You could take Coke and Pepsi, or any two competitors at the same level. So in this case, if they both choose to cooperate, which is they both choose to keep the price of their product high, they will both earn a profit of, let's say, $500 each. But if one of them chooses to deflect from this agreement, for example, let's say Apple chooses to deflect, they will do so because they think that they will earn a profit of $750 instead of $500, which is a good enough reason for them to deflect. And similarly, if Apple chooses to cooperate, but Samsung chooses to deflect, they will be tempted by the fact that they will earn $750 instead of $500. But when one party chooses to deflect, the other party has no increase in its profits. So the profits will be zero for them. And what this happens is, what if, let's say, Apple decides to deflect and Samsung decides to deflect, then both of them would reduce their profits completely down to $250. So what they were initially earning of $500, now they're just earning $250. And since this is a simultaneous decision, they don't know which one is going to deflect and which one's going to cooperate. So they just have to take the decision themselves. And a price drop by either company can be then, it'll basically, one sec. I'm just going to open the matrix a little. Yeah, there you go. So while they're acting in their best interest, what this can happen, it can backfire, and then they can end up earning a lot less as compared to what they were earning initially. So this is what we call the prisoner's dilemma, and it happens in a lot of situations in the real world. Yeah, I think that
covers it. And one thing I'd just like to add on to this, right? To all our viewers seeing a payoff matrix for the first time, the first number you see in each box is the payoff for player one, which is usually the row player.
Oh, yeah.
So in this case, it would be Apple. And the second number you see after the comma is the payoff for the second player, which is the column player, which in this case is Samsung. And as Sanaa explained very well, the two choices here could stem from a possible collusion that the two companies have had. So and we'll get and in short, what collusion is when two companies or two or more companies rather quite implicitly come up with an agreement that they will either fix price or quantity of their goods at a certain level so that both companies can profit from that agreement. So in this case, cooperating would mean going ahead with that agreement and sticking to a certain quota on price or quantity that both companies here have agreed with. Deflecting or defecting from it would mean straying away from it and having your own independent strategy. And as Sanaa put it, right? So the two pure strategies you have are to cooperate and deflect. In another example, if one strategy kind of gave you an optimal outcome on both fronts, that would be a pure strategy, Nash equilibrium, where you have one strategy that works regardless of what the other player does. But in this case, as Sanaa puts it as Sanaa explained very aptly, right? In this case, they realize that they both need to deflect because at the point at which one of them does deviate and tries to cooperate, the party that deflects gets a much higher payoff, being 750, and the party that opted to cooperate would lose out significantly. So they both end up being stuck at that 250 equilibrium that has been highlighted in green. And that ties us very nicely to our final definition on the Nash equilibrium. And the green box that Sanaa has highlighted is the Nash equilibrium in this case, where both parties stick to a certain equilibrium because there is no incentive for either party to deviate in order to get higher payoffs. Sanaa, have I explained that well? Is there anything you'd like to add on?
Yes, I'm just going to correct myself in one place where I said simultaneous. It's actually sequential, because when one party decides to deflect, then the other party has no choice but to deflect as well. Because if Apple decides to deflect and gain a profit of 750 instead of 500, Samsung would not let them do that. So they will also decrease their prices, and then both of them would end up deflecting and then earning lesser profits. Yeah, so that's why I wanted to correct myself.
No, exactly. And no, but you were right earlier as well. This could happen in both a simultaneous or a sequential scenario. And I think this perfectly explains everything that we wanted to get to in terms of the Nash equilibrium and pure strategies. And that also helps us wrap things up at that proposed roughly around that 20-minute mark. But before we go, just a quick thank you once again to Sanaa for joining us. And I hope you enjoyed being a part of this.
Yes. Thank you so much for watching.
Thanks, guys. And join us next week. We'll cover another 6 or 7 definitions. And if you couldn't catch us during our live session, this will be up on our YouTube channel and also on our Instagram page shortly. So continue to keep an eye on Econ, and we'll see you next week.